Today I have a special video and we're going to take a look at the market rhythm. Why does the price move? How does it move? Why is it fast sometimes? Why is it slow? Where's the market going to go next? And on top of that, I've included one of the best entry strategies that you can use to time the trades, to find the market rhythm and to get into a good position. In this video, we're going to learn to take a look behind the price action, behind the candles. We're going to understand why is the market moving? Why is it sometimes moving fast? Why is it sometimes moving slow? Why is it sometimes going very steep and sometimes it's more moving shallow? Why is sometimes the trend turning from an uptrend to a downtrend? What are those transition periods and how to position ourselves to find the best trades? And that's very important because behind every candlestick, behind every move, there is a buyer and there's a seller. There's interaction going on, there's profit taking, there are stops, and we need to know that in order to find the best trades. And we're going to start very basic and then move into the more advanced concepts during the video. So make sure to stick around until the end to get to the most advanced. When we look at a price chart, we are able to see that the market is moving in waves. There are trend waves and then there are corrective waves. The trend waves, that's the most interesting thing for us as a trader because the trend waves are the periods where the market moves the most in the shortest amount of time. Why is that so? Because there's a lot of imbalance here. There are way more buyers than there are sellers. And when there is such a big imbalance, when you have way more buyers than you have sellers, then the market is going to shoot up because it will go to a price where it's high enough so that some more sellers are interested to sell and some of the buyers are interested in taking profits. And that's then leading to those corrective waves. And the corrective waves are really the key for profitable trading because they tell you a lot about the underlying dynamics. Is the corrective wave very long? It shows you that the people who have been buying here, probably a lot of them have been taking profits. And if a buyer takes a profit, that's a sell order that's going to drive the price down. So if we see that a corrective wave is going very, very long, it shows you that the buyers are exiting, or maybe the price has become so high that it is interesting for the sellers to sell now. Because as the price goes higher and higher, more and more people who previously thought the price is too low to sell are now getting more interested. So what is very important here at this early stage is to understand that the market moves in trend waves and then there's a corrective wave. It's a natural rhythm because as the market moves higher, some people who are in profits are going to take some and more sellers are going to go in. However, there is a point coming where the corrective wave turns into the impulsive wave, where the profit taking is over and where there are no more sellers interested. And the price has been moving lower a little bit so that it's more attractive for the buyers again, because as something gets cheaper, you probably are more interested to buy it, right? So timing this transition here between the corrective and the impulsive wave, that's really the key. That's where you make the most money. And sometimes this is referred to as pullback trading, corrective waves, and we are going to take a look at those continuations in this video. So when we look at now a real price chart, we will be able to use this knowledge of the trend waves, correction waves, trending waves, and we are able to apply this to our charts. And you can see we have our impulsive wave here, then followed by a corrective wave, impulsive wave, corrective wave, and impulsive wave. This is a very typical market behavior. You're often able to find this on your charts. Not always as nice as here, but very, very often very close. And what we can see is obviously that the market moves the most in those trend waves. You can see here in a short amount of time from C to D, the market moves a lot. From A to B moves a lot. From B to C, not so much. From D to here, which is E, not a lot. You can see the market did move higher, but not a lot. So looking for trading opportunities that make you more money in a short amount of time is best done during those trend waves, C to D, A to B. And that's what we're going to focus on. And one tool that we could use is the so-called Fibonacci extension and retracement tool. And this tool is so powerful because it helps us first of all to understand the corrective wave from point B here to C. We can use the Fibonacci retracements and at the same time we can use the Fibonacci extensions, the ones here, to find the right target because those levels 138, 161, they are perfect for taking exits because they work so well for target placement. Okay, so now one step at a time, and by the way, at the end of the video I will go into the live markets and I will show you how to actually use and draw the Fibonaccis on your charts, how to set them up, what are the best settings, and that is what we're going to do at the end. But for now, what we are going to do is we are using our Fibonacci tool and we just simply drag it from point A to point B. So we have to wait for one of the trend waves to finish. That's the very important thing. So A, the top, to B, the bottom. That's where we have our Fibonacci. We draw it. And then what we're going to get is the Fibonacci extensions. I know a lot of you are going to scream now that my Fibonaccis are drawn in the opposite way, but that's not the case. And I will show you in a moment why that is the better way to use Fibonaccis. And then you can see point B to point C. That's really where it gets interesting, because those corrective waves, the B to C move, it often stops somewhere between 38 and 76. If you draw it opposite, that's 23 and that's 61. Doesn't matter. So there is this ratio here that the market is following. Corrective wave B to C should not exceed this 38.2 level. If it goes beyond that, what does it mean? It means the corrective wave is too strong. It means that there's too much profit taking of the sellers going on and there are too many buyers. That's what we don't want to trade. So ideally, the corrective wave stops between somewhere 38, somewhere between 76. That's ideal. And then after we have done that, here's then where we're going to look for entry timing. That's the key. The transition from the corrective wave B to C to then the hopefully next impulsive wave C to D. That's then where we want to trade. And I will show you in a moment how to do that. And for target placement, that's where the Fibonacci extensions come in. And very often you will see that the trend wave, the next one after the corrective wave, is ending either at 138 or at 161. It's very common to see, and that's a very interesting dynamic that the market is showing. Why is that so? I thought about it a long time. And I've been using Fibonacci's for many years. And I just think that it has to do with the market psychology. The B2C move is a little bit more obvious. We don't want to have steep retracements. We don't want to have steep corrective wave. This would show that the balance is shifting too much. We still want to have more sellers here in this market. So we don't want to have the B2C too strong. The C to D, on the other hand, again, as the trend unfolds, more and more people are going to sit on profits. And if you know one thing about traders is that it is very hard to sit on unrealized profits, and many traders are inclined to close their positions if they are sitting on a win often too early. So the longer it goes, the higher the likelihood that the traders are going to close their profits and going to realize the profits. And then again, we're going to have profit taking. And you can see this profit taking is now taking more long than here. The B to C, very short. D to E, much longer. Why is that? Probably because way more people now have way more profits, because the downtrend started from here. Down here, there will still be some sellers left from the initial sell, and we have new sellers from this trend wave here. So more people do have short positions, more people want to exit and realize their profits. That's why D to E then takes a little bit longer. Another reason what could be behind the fact that the trend waves seem to follow a very specific rhythm and often have very similar size is just the way that traders execute their trades. Let me show you what this means. So we're drawing our Fibonacci, let's say from the point A, and then we select this as our point B. And you can see we have a very nice 50. And then you can see currently we are at 161. All right, why is it that the market very often has very similar length for the trend waves? And I think that has to do with the reward to risk ratio, because very often traders use the standard reward to risk ratio setting, which is probably somewhere between 2 to 1, 3 to 1, 4 to 1. So it's very common to see that the market is going to go for that specific amount. So assuming that we have now here point A, and we should have this maybe in black, and this is our point B and C. So people are going to look for short opportunities now, right? And how they're going to approach their trades. And it should be quite obvious. So maybe we have our trend line here, and that is then what traders are going to use, right? So one option would be, okay, we're going for a short, we wait for the trend line to break because we have everything here. And where's our stop going to be? Maybe around the previous highs. And then let's assume we go for a 2 to 1. And you can see 2 to 1 here. The reward to risk ratio tool shows it. This is how 2 to 1 looks like. And coincidentally, it's falling into 161.8. So is it magic that the 161.8 works so well, or is it just a natural consequence of how traders approach their trading? They're waiting for the corrective wave, they're waiting for maybe a breakout, their stop loss goes at a natural support resistance level, uses local highs and lows, and then they're shooting for 2 to 1, 3 to 1, 4 to 1. And those targets, the 2 to 1 target often falls into 161. So it's probably the chicken and the egg problem. What comes first? Is it that this 161 is just a magic number and the market seems to be attracted to it? Or is it that the 2 reward to risk ratio often falls into where the 161 is. You let me know in the comments below what you think, but I've come to the conclusion that probably this is very common. Other traders may use a little bit more of a tight stop loss. And then you can even see, even if we put it here above the previous breakout area, above the trend line, we get the 4-to-1 reward to risk ratio, which is also common. And again, it falls at 161. Assuming 138, you can see this is almost the 3-to-1. So very often those 2-to-1, 3-to-1, 4-to-1 round reward to risk ratios fall into the Fibonacci areas, and they show you how traders would approach it. So it's always helpful to put you in the shoes of other traders. In recent videos, we talked about stop runs, why it's important to understand how people place their stops so that you can avoid stop runs or use fake outs to your advantage. And in this time, it's also important that we understand how are traders going to approach their breakouts, their trends, and that is then how we can trade more alongside with them, avoid a lot of common problems, and just realize trades that go into the target in a short amount of time. And what we can do is to improve this way of looking at charts is we could add a moving average for a trend filter. So here is the 50 period SMA. You can use the EMA as well, and you can use that on any time frame. The 50 period really works nice on all the time frames. So what we have is we have the market is below the moving average, right? This is the line, this is the price, we are below it. So this means that you are in a short market. You are looking for short opportunities. You want to sell. And what you want to do is you want to wait for the market to finish the impulsive wave, the trend wave. Then you are waiting for the corrective wave. In this case, we draw the Fibonacci from here, point A, this is the top of this trend wave, to the bottom, which is here, the lowest point, point B. Then we can see we have a perfect retracement somewhere here, 61.8, very nice reactions. And then you can see we could draw a trend line. If we, for example, would now go to a lower time frame, maybe this is the 1 hour, we go to the 15-minute, you would see that this is a double top. Maybe in here you even have some head and shoulders pattern. Then you can draw a nice leg line, and on the breakout, that could be your entry. And you can see again, 138, 161. In this case, we made it all the way to 200, which is not super common. So if you're using Fibonacci's for target placement and you don't want to be too aggressive, then probably 161, 138, somewhere in here, that's the sweet spot. That's where you usually see the biggest reactions. That's the most common one. Holding all the way to 200 is a little bit more risky because often the market will turn around before that. Another example here, and the good thing about Fibonacci's is that you don't have to be perfect drawing them. There are many ways to draw them, as we will see here. So the market was in a downtrend below the moving average, and then it seems like we broke above the moving average, had a retest. So we draw our Fibonacci from the lowest point of the downtrend, which is then also the starting point here of the first bullish wave. So we draw it from here to here, the first high here that got us above the moving average. Then we have a perfect retracement at the Fibonacci 61.8. And you can see we are now at 138.2. So very quick and easy win here. And that is one way. If we now wait for a few more candles, we could draw the Fibonacci differently. We could use A and C differently. So here you can see this was our first one, A, B, C, and we could also now change to a little bit of a wider fib. We use the same A point, but the B is now the previous endpoint. So whereas this was our first 138 extension, we use this as our B point now. You can see A, B, C, perfect retracement here at the 50 level, almost all the way to the 38. And also the moving average held as support, which is another important factor. If you have retracements and if you see that the moving average is broken, you would like to see it being retested as support. And then you could, for example, again draw a trend line in here to define the B to C wave. And then on the breakout, you could then again initiate a long. You can see this time we made it to the 161.8, which is a reasonable target. You can see in a short amount of time, the market made its way here. And you would be able to trade this trend wave very simply. Another way that we could improve the way to use Fibonacci's and help us find the trend waves a little bit differently is using a pivot. Here I turned on the weekly pivot point. I can also show you at the end of the video when we take a look at the Fibonacci, how to draw them, how to set up your pivots. So if you're interested, and I've seen a lot of comments around that, make sure to stick around until the end and I will show you how to set up your pivots. And again, what we do is we look for a trend wave. We have a trend wave here that brought us below the pivot. If you're trading below the pivot, you are generally in a short market. You want to look for selling opportunities. So we have our A to B move. We draw our Fib from the highest point to the lowest point. We have our retracement perfectly into the weekly pivot point. It doesn't get any better. We have a lot of confluence. First of all, we have some support here, which is turning into resistance. We have the pivot, and we have our Fibonacci retracements, 61.8. Very great confluence here. And then you can see on the way down, we first made it into 138. We had a little bit of a bounce, and then we made it eventually to 161.8. And now you can see it has been hovering. After the market hit 138, it took really a long time to go to the next Fibonacci's. So holding on and waiting for the next Fibonacci is sometimes going to give you a bigger winning trade. But on the other hand, there are also some downsides. First of all, the holding time would be much longer. You can see we have, what is that, 10 candles maybe that brought us here from the top to the 138, and then another 20 or more candles that would then take us from 138 to 161. So a longer holding time, more risk that the price is going to reverse on you, and that actually 138 becomes a support and we see a bounce higher. So shooting for the big Fibonacci's is not always a good idea because it increases the risk. We can also have a very interesting study here. You can see the market was in an uptrend and then it rolled over. We had this triple top and then we have multiple trend waves. Go down, go up, go down, go up, go down, go up, go down. So what can we do here with this market rhythm and how can we use Fibonacci's? So we're going to look at the first section here, then to the red and then to the green. So here we draw our Fibonacci from point A to point B. Fibonacci retracement 161 gets us to 161 very easily. Then we're going to focus on the next part. This trend wave to this trend wave, we have a 38.2 retracement. And on the way down, you can see we reach 127, very big retracement here. Eventually we go lower, but this time it would have taken quite a bit. So we can also focus on this one here. As we're probably holding the previous one, we can look at the next trend wave as well. So we draw it from here to here. We see, okay, 38.2 has held. We are not going too deep, which is also a good confirmation for your previous trade if you're still holding on to this one and it's taking too long. This Fibonacci gives you a little bit more reassurance that the downtrend rhythm has not been broken and it's still very much in play. And you can see from 38 we go to 127, 138 and then very nicely to 161 as well. So this is a good way of really following the markets, how to get a better understanding of trend waves, of the depth of trend waves, understanding when is it too deep, when is it still okay, and you can use it to any market. Whereas previously we have mostly taken a look at Forex. You can see Bitcoin, this is the most recent chart, and I didn't have to search long for Fibonacci, just the recent price move. A to B, retracement to 61, 127 first, 138, 161, and now maybe even 200. Or indices, this is the most recent chart of the US 100. You can see A to B to C. We made it to 127, had a bounce, and then eventually 138, 161, and again on the way to 200. And also you can use it on individual stocks. Netflix, we are using here the monthly pivots for long-term trend direction. We draw the Fibonacci from A to B. We have a very nice retracement to 61 into the weekly pivot. And then you can see we jumped all the way here to 138 and currently we're trading around 161. Two things to maybe not do or just be a little bit cautious about is first, you don't want to have retracements that are too deep. You can see here's the point A, point B. And this C move goes all the way above the 38. This, in my opinion, is too deep. I wouldn't trade that. Even in some cases, this will work out. In my experience, it's not worth exploring. Why is that so? Again, as I mentioned at the beginning, this is moving lower because there are more sellers than buyers. A lot of people are selling, not too many want to buy. If then you see that the market is shooting up, almost coming close to the previous top, that's a sign that there's a lot of bullishness. And that can be one of two reasons. First, it could be sellers taking profits and driving the price up, or it could just be more buyers in general coming into the market, which is not a good thing if you want to sell. If you think that you are in an overall downtrend, that's the last thing you want to see. You want to see that the market has a little bit of opposition here, but not too deep. So ideally, you want to stay between 38, 76. That's the ideal ratio. In this case, it's borderline, and what we have here is that the retracement is too shallow. In the past, I would have said that this is also not advisable, and you at least want to wait for the market to reach 76 or 23. But I think my opinion has shifted, and what this does is actually it doesn't show a lot of problems here, because what does it mean? We have a lot of selling, then a limited amount of corrective wave time, very weak buying, very weak profit taking. So whoever sold here, not a lot of them were interested in profit taking, right? Otherwise the market would have moved higher. And also a lot of sellers are coming in, not a lot of buyers. So actually this is not a problem anymore in my eyes, but I think this is even a good sign. Granted, it will be a little bit harder to time the trade because the corrective wave is just so short, so weak. Not very often we will get a pattern, a trend line in to actually time the market, but this is not a problem anymore. Maybe this is something that is actually worth exploring, where you can try to build a strategy around that. So now let me show you how to set the Fibonacci up in your trading view. And what we first have to do is just select the Fibonaccis, and you can find them here on the left side in the menu. And then there are here Fib retracement. Alt and F is the short key, seems like it. And for the first time, when you have not set it up, we just need to select it, click on it, and then we just have to apply it to our chart. Doesn't matter, we just have to change the settings. So we just throw it on the charts, and in your case, it's probably going to look a little bit differently, but that's okay. We're going to set it up. So after you've drawn it to your chart, you have here the settings option. If you don't have it, if you have maybe clicked away and you have lost the settings, you just reselect the fib, and then here you have your settings, and then you can take a screenshot of what I have here. So what I have is the 38, I have the 61, 261, 127, 50, 76, 161, 138 and 2, which is the 200. Also here you can see what I use is reverse, which is then sometimes people refer to it as I draw them opposite, but that's not the case. I just use the reverse because I need to have the Fibonacci extensions. You can see if you unreverse it, then the extensions will be at the top or in the opposite way. And for me personally, I just have gotten used to it, to drawing the Fibonaccis that way over the years. Of course, there's no difference whether you draw it reverse or not, because they are percentage based, so there's no difference. So get over it, there's no problem here. Levels, percentage, that's all default, I think. Coordinates, doesn't matter. Visibility, doesn't matter as well. So you can screenshot this and then you can set it up on your charts. And now we have set it up, and let's delete it, and then we can draw it very simply. You can see we have a probably point A, B, and then C. This is the current recent chart, so you don't have to look for a long time to find actually Fibonacci's. So we draw it from here, then we just draw it from here to point C, and then we just extend it forward, or point B, sorry. And you can see point C is here, 61.8, very nice confluence. The 138 has been already achieved, and we came very close to the 161. So there's a good likelihood that the trend is at least over for now, or maybe we are able to get into a new trend wave soon. So what we could do is observe the next price. So we draw it from A to B here. Just go forward a little bit, and you can see we are somewhere here very at the bottom. And if there is maybe a next trend push, then we could use that, maybe wait for the breakout here below the low. That's the most reasonable pattern I see currently. And then you have the targets to the downside that you could use. That's it, very simply. And because a lot of people ask me about the pivots, let me also show you the pivots. It's very simple. You go to indicator, and then it's called pivot standard. So you can just turn pivot and then pivot point standard. That's it. Now you have it on your charts, and that's how it looks. I only use the central, so what we do is go to the left here, and we open the settings. And then first of all, I deselect all the SNR. I don't use them. I don't find them very helpful. And I only use the pivot point, the central. You can make it a little bit thicker. You can see then the line is thicker. Let's actually make it blue. And then you can choose the pivot time frame. So what I would recommend, if you trade the lower time frame, 5 minute, 15 minute, 30 minute, 1 hour, then choose the pivot point daily. If you trade anything above the 2 hour, 4 hour, 12 hour, then I would choose the weekly. And then you can see you get the different pivot points, and then how you can set it up on your charts. Very simple, very straightforward, but very good tools to have on your charts that will help you improve the quality of your chart reading, your understanding for trend waves, and hopefully find better trades.